You have spent 4 episodes with me. You have learned about the petrodollar system, the BRICS mechanisms, the Treasury market feedback loop, and the historical silver-gold pattern. And if you are like most of the investors who have written to me across this series, you are sitting with a combination of 2 feelings that don't usually arrive together. The first feeling is clarity. For the first time, the pieces of the global financial system make sense. The petrodollar, the recycling loop, the Treasury market, the silver setup, it connects. The second feeling is anxiety, because clarity about a structural problem is not the same as knowing what to do about it. And sitting with structural knowledge without a practical framework is its own kind of discomfort. Both of those feelings are completely appropriate. And this episode, the final episode of this series, is built to close that gap. I'm the Stack Guy. This is episode 5, the final episode of the Petrodollar Collapse Series, building a Petrodollar-Aware Portfolio, a framework, not a formula. Before anything else, I need to say something directly, something I have been building toward across all 5 episodes and have not yet said plainly. I built this series because I believe there's a generation of American investors, people in their 50s and 60s, who built real wealth through real work, who are being systematically underserved by the financial advice industry. The financial advice industry is not malicious. It is calibrated to a world that existed for 50 years and is now changing. The advisors are not lying to you. They are using maps drawn for different terrain. The world that the 50-year-old financial planning model was built for featured a stable dollar as the unchallenged global reserve currency, treasury bonds as the risk-free return anchor, and inflation as a manageable, predictable background condition. The world this series has documented features a dollar whose reserve share has declined for 25 consecutive years, treasury bonds that produced their worst 2-year return in modern history in 2022-2023, and inflation that caught an entire generation of financial advisors off guard. This does not mean the old model is worthless. It means it requires updating, and that is precisely what this final episode is about. I'm going to give you the framework I use, not a formula, not a specific allocation percentage, a framework. The distinction matters enormously, and I'll explain why. A formula says, put X% in silver, Y% in gold, Z% in treasury bonds. A formula is seductive because it is simple. It is also dangerous because it cannot adapt to your specific situation, your specific timeline, or the specific way structural forces develop. A framework says, here are the forces acting on the system. Here is how they interact. Here is what you need to know about your own situation to decide how to respond. Then you and your advisor make the decision. The framework has 4 components. I'm going to walk through each one. Then I'm going to show you how they interact. Then I'm going to give you the questions, specific questions that determine how each component applies to your specific situation. Component 1, understanding your exposure, what you already own and how it is affected by the structural forces this series has documented. Most investors in their 50s and 60s hold a combination of the following: employer pension, 401k or IRA invested in a target date fund or diversified mutual fund, some individual stocks, a home with equity, and possibly some cash or CDs. Here's what most investors do not realize. The target date fund in their 401k is typically invested 40 to 60% in bonds. Those bonds are predominantly US Treasury bonds and Treasury-linked securities, which means their 401k is significantly exposed to the Treasury market stress scenario this series has documented. I'm not saying get out of your 401k. I am saying look inside it, understand what it actually owns, because Target Date 2030 Fund is a label, not a structural description. Your pension, if you have one, is another exposure point. Pension funds invest heavily in Treasury bonds as their safe allocation. The structural forces acting on Treasury markets act on your pension fund's asset base directly. Your home equity is the asset most people do not think about in this context. But home values are sensitive to mortgage rates. Mortgage rates are tied to Treasury yields. The Treasury market feedback loop from episode 3 runs directly through your home's value. Before you add anything to your portfolio, before you buy a single silver coin, understand exactly how your existing holdings are exposed to the structural forces this series has documented. That audit is step 1. Component 2, understanding your timeline. Because the framework that makes sense at 45 is not the same as the framework that makes sense at 62. If you're 45, you have time. You have the ability to ride out volatility, to build a position incrementally, to allow structural forces to develop over a decade without needing to liquidate in a downturn. Your framework has patience built into it. If you are 62, you do not have a decade of patience available. A structural shift that takes 10 years to fully develop does not help you if you need to draw from your portfolio in 3 years. Your framework must account for your withdrawal timeline. The questions to ask yourself about your timeline: when do I need to begin drawing from this portfolio? How much do I need per year? How much volatility can my withdrawal schedule tolerate? The answers determine the urgency and the size of any repositioning. Component 3, the hard asset allocation. How much, in what form, and stored how? How much? The honest answer, the one this channel can give you, is a range, not a number. And the range is determined by your exposure audit and your timeline assessment from components 1 and 2. Investors with high treasury exposure, long timelines, and high risk tolerance, the structural case supports a meaningful hard asset allocation, potentially 15-25% of investable assets across gold and silver combined. Investors with pension income providing a floor, shorter timelines, and lower risk tolerance, the structural case still supports a hard asset position but smaller, and weighted more heavily toward gold's stability than silver's volatility. In what form? This is where I want to spend serious time. Because the form in which you hold silver, specifically physical, ETF, mining stocks, futures, determines your actual exposure profile in ways most investors do not fully understand. Physical silver coins, rounds, and bars in your personal possession or in a private non-bank vault is the form most directly aligned with the structural thesis this series has built. It is outside the paper system. It cannot be cash settled. It cannot be confiscated by a rule change at COMEX. Physical silver has 3 practical considerations that every investor must address: storage security, insurance, and liquidity. But these are not arguments against physical silver. They are the responsibilities that come with the most structurally sound form of ownership. For storage, do not store significant quantities of silver in your home without a proper safe bolted to the structure. Do not tell people you own physical silver. Discretion is as important as the safe itself. For insurance, most homeowners' policies have a cap on precious metals coverage, often as low as $1,000 to $2,500. If you hold meaningful quantities of physical silver, you need a scheduled personal property rider or a specialist precious metals insurance policy. For liquidity, know your exit before you need it. Identify your local coin dealer, the online buyback programs at major dealers, and understand that physical silver has a bid-ask spread that does not exist in an ETF. Liquidity is real, but it has friction. Silver ETFs, SLV, and SIVR primarily offer the liquidity of a stock trade with exposure to silver price movements. They are appropriate for investors who need portfolio flexibility, who operate within tax-advantaged accounts, or who cannot practically store physical silver. The important caveat for silver ETFs: read the prospectus, understand who the custodian is, understand that in an extreme market dislocation, the scenario we discussed in the COMEX episode, the ETF price and the physical price could diverge in ways the prospectus acknowledges, but most investors overlook. Silver mining stocks, the major primary silver miners, and the silver royalty companies offer operating leverage to the silver price. When silver rises, well-run miners can rise faster. The risks of silver mining stocks are not the risks of silver. They are the risks of running a company management decisions, geopolitical risk in the mine's jurisdiction, energy costs, labor disputes, permitting. A silver miner is not a silver substitute. My practical suggestion for hard asset allocation form, and this is my framework, not financial advice, is to think in layers. Physical first, ETF second, miners third. Each layer serves a different purpose. Physical is your structural foundation, the layer that survives institutional failures, COMEX rule changes, and ETF custodian issues. It is slow, it has friction, and it is the most important layer. ETF is your tactical layer, the layer that lets you adjust exposure quickly, rebalance efficiently, and hold silver within a tax-advantaged account. It is faster, it is more flexible, and it is the second layer. Miners are your return amplification layer, the layer that captures additional upside if the structural thesis develops strongly. They are riskier than physical or ETF and should represent the smallest layer for most conservative investors. Component 4, the monitoring practice. Because a framework without ongoing monitoring is not a framework. It is a one-time decision. The monitoring practice I use and that I have shared across this series is the 5-metric accountability scorecard. I have updated it every episode. I'm going to update it one final time today, and then I'm going to tell you how to maintain it yourself going forward. Metric $1 share of global Forex reserves, 58.4%, a further small decline from the 58-59% range of previous episodes. The 25-year trend has not reversed. In the 5 episodes of this series, this metric has moved consistently in one direction. Metric 2, yuan oil settlement. This period registers the first quarter where yuan settled oil trade volume has exceeded 4% of global oil trade. We have not yet reached the 5% signal threshold, but the distance to that threshold is now measurable in months, not years. Metric 3, central bank gold purchases above 300 tons for the 5th consecutive monitoring period. This metric has been at signal level for the entire duration of this series. It has not normalized. It has not even shown meaningful deceleration. On metric 4, gold to silver ratio, the compression that appeared as a single data point in episode 4 has continued. The ratio has moved from approximately 90.1 to approximately 78.1 across the monitoring period. A compression of 12 points. This is now a trend, not a data point. Metric 5, US Treasury auction demand. The bid to cover ratio on the most recent 10-year auction has crossed below 2.3, a level that has historically preceded periods of yield spike and Treasury market stress. This metric has entered signal territory. Final episode summary, 2 metrics at signal level, central bank gold buying and Treasury auction demand. 1 metric in accelerating approach, yuan oil settlement at 4%. 1 metric showing confirmed trend gold-silver ratio compression. 1 metric continuing its 25-year trend dollar reserve share decline. I want to stop here before the practical conclusions and say something that I have been holding back for the right moment. This moment. If you're 58 years old and you watched this entire series, 5 episodes, 5 accountability updates, 1 structural argument built from foundation to conclusion, you did something that most investors never do. You invested approximately 2.5 hours of your finite time to understand the structural forces acting on your financial life. That is not a small thing. Most people spend more time researching a refrigerator purchase than they spend understanding their retirement allocation. You now understand something that genuinely matters. And understanding that matters is rare. It is worth acknowledging before we move to the practical conclusions. Now, the practical conclusions. What does a Petrodollar-Aware Portfolio actually look like? I'm going to show you 3 profiles. These are frameworks, not prescriptions. They are starting points for a conversation with your financial advisor. Profile 1, the 45-year-old with time. High Treasury exposure in current 401k, long timeline, moderate risk tolerance. The structural case most clearly applies to this investor. For this investor, the structural case supports a meaningful hard asset allocation. Suggested range, 15 to 20% of investable assets in hard assets, weighted toward physical silver and gold for the monetary thesis, with a smaller allocation to quality silver miners for amplification. Profile 2, the 58-year-old with a transition window, mixed exposure, 10-year horizon to full retirement, but drawing may start in 5. The structural forces have a shorter window to develop for this investor, but the window is real. For this investor, the structural case supports a defensive hard asset allocation weighted toward gold's stability over silver's volatility, with physical holdings prioritized over mining stocks. Suggested range, 8-15% of investable assets. Profile 3, the 65-year-old already in retirement. The structural thesis is real, but the timeline is most constrained. Volatility is the primary risk. Income stability is the primary requirement. For this investor, a small hard asset position, 5 to 10% in physical gold primarily, with a modest silver allocation, functions as a portfolio insurance position rather than a growth allocation. The structural thesis is acknowledged, but the timeline demands conservatism. 3 profiles, 3 completely different allocations, the same structural forces. The framework produces different outputs for different inputs, and that is precisely why it is a framework and not a formula. Before I give you the final monitoring guidance, I want to address the question I know some of you are carrying. The question you have not asked out loud because it feels too personal. Is it too late? Have I missed the window? If the structural forces are already developing, if the scoreboard already shows 2 metrics at signal level, have I already missed the opportunity? The answer, and I want to say this clearly, is no. You have not missed the window. And here is the data-supported reason why. In 1979, investors who bought silver on January 1st at $6 per ounce and sold at the January 1980 peak of $50 made over 700%. But investors who bought silver in September 1979, 9 months into the move at $16 per ounce and sold at the January 1980 peak, still made over 200%. If the structural forces this series has documented are real, and the scorecard suggests they are developing the structural move that follows them, will be large enough that multiple entry points will have produced meaningful returns. What matters is not whether you bought at $20 or $24 or $28. What matters is whether you are positioned for the structural thesis, if it develops, and whether your position size reflects your actual risk tolerance and timeline. The ongoing monitoring practice, how to maintain the framework after this series ends. The 5 metrics I have tracked across this series are your ongoing monitoring framework. I'm going to give you the specific update schedule, the specific data sources, and the specific threshold levels that should trigger a review of your allocation. Metric 1, dollar Forex share. Check IMF COFIER database quarterly. Signal threshold, below 55%. Current reading, 58.4%. Distance to signal, approximately 3 to 4 percentage points at the current rate of decline. Metric 2, UN oil settlement. Check BIS quarterly review and IEA oil market reports. Signal threshold, 5% of global oil trade. Current reading, 4%. Distance to signal, approximately 1 percentage point months, not years. Metric 3, central bank. Gold purchases. Check World Gold Council Quarterly Demand Trends Report. Signal threshold, above 300 tons per quarter. Current reading, above threshold for 5 consecutive periods. This metric is at sustained signal level. Metric 4, gold-silver ratio. Check any precious metals, data provider daily. Signal threshold for compression trend, ratio below 70.1. Current reading, 78.1 in compressing. Distance to signal threshold, 8 points at current compression rate. Metric 5, Treasury auction demand. Check CME Group Treasury auction results after each 10-year auction. Signal threshold, bid to cover below 2.3. Current reading, at threshold. This metric entered signal territory in this final episode. When 2 or more of the 5 metrics reach signal level simultaneously, that is your trigger for a portfolio review conversation with your financial advisor. Not panic. A review. A scheduled, calm, informed conversation. And here's the final thing I want to say, the thing that is actually the most important practical instruction of this entire series. Talk to your financial advisor. An actual conversation, not a passive review of your quarterly statement, but a conversation where you say, I have spent time understanding the structural forces acting on the dollar, the treasury market, and precious metals. I want to understand how my current allocation accounts for these forces. Your advisor may be surprised that you are asking. That is fine. A good advisor will engage with the question seriously. A less prepared advisor will give you a dismissive answer, and that dismissiveness is itself information about whether you need a different advisor. The goal is not to convince your advisor that the dollar is collapsing. The goal is to have an informed conversation about whether your current allocation has considered the structural forces that have been developing for 25 years, and whether some modest adjustment might be appropriate for your specific situation and timeline. Before the final CTA, the scorecard one last time. Complete, all 5. The series final data accountability. 2 metrics at signal level, 1 metric approaching threshold, 1 metric in confirmed compression trend, 1 metric continuing its 25-year slope. The structural case is not theoretical. It is measurable. It is in the data. Now the final CTA, and I'm going to make it personal in a way I have not done in any of the previous 4 episodes. I want you to do one specific thing before you close this video. Not subscribe, not share. One specific thing. Write down one thing that you're going to do differently with your financial life as a result of watching this series. Not a big thing necessarily. One thing. Concrete. Scheduled. With a date attached to it. Maybe it is. Schedule a conversation with my financial advisor by specific date. Maybe it is. Open CommitteeGroup.com and look up the registered silver inventory tonight. Maybe it is. Look inside my 401k and understand what percentage is actually in treasury bonds. One thing. Concrete. Dated. Tell me what your one thing is in the comments. Not because I need engagement, because writing it down and telling someone you are going to do it dramatically increases the probability that you actually do it. The research on implementation intentions is clear. If you have watched all 5 episodes, if you have made it to this final moment, subscribe. Because this series is ending, but this channel is not. The structural forces we have documented do not stop developing when episode 5 ends, and this channel's commitment to tracking them honestly does not stop either. Episode 6 of this channel's analysis will track the 5 metrics forward, updating them every quarter, with the same rigorous format. No goalpost moving, no selective reporting, the same 5, the same format, ongoing. And one final thing. If someone you care about, a spouse, a sibling, a friend, has spent their working life building something real and has never had someone explain the structural forces acting on that something in plain, clear, honest terms, send them episode 1. Not to alarm them, not to predict a collapse, to give them the vocabulary and the framework to have an informed conversation about the structural forces acting on the savings they worked 30 years to build. The structural forces we have documented across 5 episodes are not going to resolve themselves in the next quarter. They are developing across years and decades, which means the most valuable thing you can do right now is understand them clearly and then act calmly, informed, and without panic. Stack smart, stack with data, stack with patience, stack with the understanding that the structural forces we have documented, petrodollar erosion, treasury market stress, central bank gold accumulation, industrial silver demand, are patient forces. They reward patient investors. I'm the Stack Guy. Thank you for 5 episodes. I will see you in the ongoing analysis.